it?
No.
No. Yeah.
I've seen like one.
Which?
The first one.
Two.
No, like one. No, we did for entities.
It was like.
And I included it.
Oh, okay.
Oh, we're not supposed to. Oh, I'm putting it in.
I was just gonna do like 14 chapters, 2, 3.
Good morning, everyone. Our last week together. Many of you are continuing on with our journey on games. Okay, final exam, exactly 1 week from right now.
Yes.
Second.
Yeah, second.
Monday or Wednesday?
Monday.
Wednesday is midterm for business.
No, I mean like next I get like business entities. I guess next Monday for this class. Okay.
1 week from today, this 1 week from right now in this room. All right, on the same page. You guys scared me. Okay. Any questions on final exam? Focus on the slides. Focus on the examples. Get 1 page of notes, front and back. Use handwritten. I'll have calculators for you. There won't be much math. Multiplication. I'll make you do it by hand. Multiple choice, short answer, about 2/3. Multiple choice, short answer. If you've had my classes before, it will look very similar to that. All right, well, if you're continuing on in the next 7 days, just shoot me a note if you got any questions or something we'll knock it out. Okay. Our last topic we're going to cover this semester is chapter 10. We're going to cut it in half, roughly. I may have a little time on Wednesday. If we do, I will depending on how far we get today, I will send you a note tomorrow, and we might have a little review session at the end of Wednesday if we have time. And the way I like to do those is I will list out like the most important topics or most difficult topics, I would say, of the half semester, and then it'll be a ranking, and you guys can rank it and decide which ones you want to talk about. And I'll talk about those for the duration of the time that we have together on Wednesday. Okay. All right. So our last topic is inbound, and I chose this one over chapter 9 just because I think this one's probably more relevant. You'll either, if you practice in international tax, you will no doubt develop an international, or if you work in international tax, you will develop some kind of contacts with inbound investment in the United States. Usually, that is from a business perspective, okay? Meaning that a foreign person, right, which can be a foreign individual or a foreign corporation, is investing into the United States in a business. They're doing something, right? They're accessing our markets either from sales perspective, manufacturing perspectives, both, all kinds of things that they could be doing in the United States, but they end up subjecting themselves to U.S. tax. So the first topic we're going to talk about, I hope to get to this part of the agenda today. The first topic is at what point does their activity in the United States tip the scales to when they become taxable in the United States? Because it's not the first moment you touch base in the United States, you're subject to U.S. tax. So there's a certain threshold that you have to meet. We're going to cover that in a treaty context, tax treaty context, and a non-tax treaty context, because it all depends on whether the United States has executed a tax treaty with the foreign country of the foreign person who is doing the investment in the United States. There's different standards on that. So we'll start with that and then finish with branch profits tax this morning. And that's an interesting concept for when the foreign investment into the U.S. business is conducted in branch form, meaning that they did not form a legal entity, they just start doing business in the United States. And then on Wednesday, we're going to pick up with interest expense limitations. That is the number one issue. 1 and 1A are interest expense limitations, and then the BEAT tax, the base erosion, anti-abuse tax, are the two major issues for inbound investment from foreign corporations into the United States. They typically finance the U.S. with interest expense in large part, and the U.S. has limitations on how much of that they can take. Take a deduction to reduce U.S. tax via interest expense. And then the base erosion and anti-abuse tax was a provision of that 2017 bill, the Tax Cuts and Jobs Act, Trump 1.0. That has been kind of a big problem for inbound investment in the United States as well. That largely survived unchanged, the One Big Beautiful Bill Act. They did tweak it slightly just from the rate perspective. How that works. Okay. So I want you to keep in mind there's a two-pronged approach for the taxation of U.S. investment in the United States. What we're going to talk about today and Wednesday is Chapter 10, Inbound Investment in a Business. Just to preview, Chapter 9, which I may or may not cover in advance, is the second aspect, and that's when the investment is more passive in nature. Investment into the stock market, it's lending into the U.S., something like that, but not a full-blown U.S. business, more of a passive return from the U.S. And the issue there is U.S. withholding tax. Do the payments out from the U.S. to the foreign recipient, are they subject to U.S. withholding tax on their way out? And at what rate that is. So maybe covering that. I should have mentioned I'm going to be sitting down more today. I kind of tweaked my knee exercising the other day. So enjoy exercising while you're young. As you get older, half the battle is to not injure yourself while you're trying to improve. Okay, so we're going to be talking about the inbound investment in business. So a foreign person, broadly defined, engaged in a U.S. business is subject to U.S. income tax on income derived from that U.S. business. Yes, a little frustrating. Sorry about that. Hopefully everybody's got it pulled up. Let me just try to re-mirror here. This is, see if you can follow along. I'm on slide 4. So, the foreign person engaged in the U.S. business is only taxed on the income derived from that U.S. business, right? We have no jurisdiction to tax a foreign person over anything but their U.S. activities, right? So a French company with a distribution business in the United States, we don't get to tax the French company. We get to tax the U.S. distribution business of the French company, but we have no taxing jurisdiction over the French activities or anything else in the world, right? That's a French question in every other host country in the world. If you think about it, in this instance, the U.S. is the host country. So remember when we were talking about foreign tax credit, the host country usually taxes the activity in the country. That's what's happening here, is the U.S. taxing that host country activity. An example is of a U.S. business of a foreign corporation. Think of a sales branch operation in the U.S. So, a French car manufacturer that decides to sell in the United States might do that via a sales branch operation throughout the United States. It can be huge, coast to coast, top to bottom, but it could be done in a branch operation. We only tax that activity within the United States. Okay? Foreign person is allowed to deduct expenses related to the U.S. business and incurs tax at the normal rates of U.S. taxation. Okay? So if it's a foreign corporation doing activities in the U.S., we try to find out what activities are in the U.S., get the income, the expenses associated with that are deductions, right? We get the taxable income, and it's taxed at 21. That's how we tax foreign corporations. If it's a foreign person that's an individual, then they're subject to U.S. tax on their activities in the U.S., just as the U.S. individual would be. Income, we get expenses, they pay tax at individual tax rates. Okay? So the question is whether their economic activities in the U.S. rise to the level of a trade or business is the critical determination of whether such activities are subject to U.S. taxation. I've had this question all the time in my practice. We're starting to do stuff in the United States. Is that too much? Is it not enough? Do I pay tax? Do I not pay tax? Think of it as a sliding scale, right? You start with really minimal activities and you just keep drifting further and further. At some point on that scale, you become a U.S. taxpayer. And I'm going to talk about the standards we use from that, but it's a gray area. It's subjective, right? Each business is going to start doing different things, and you have to make a call at a certain point. So I think at the outset, as a general matter, you would like to not be subject to U.S. tax, right? Because you're kind of getting started. You don't even know if you want to be involved in the United States. You're trying to see if there's a sales market there. Is there customers for your product there, that type of thing. So you don't want to burden that with being subject to tax. But I always advise the people I were talking with is don't be afraid to become a taxpayer, because that means you're doing business. And hopefully you're making money. Remember our pie that we first started with? Don't be a hog and try to keep all of your pie. You got to give up a little 21% of it to the U.S. government. Hopefully your pie keeps getting bigger year after year as your U.S. business grows. So what if you got a silent partner that's taking 21% of it? That's not the end of the world. The question here is, if you delay that assertion that you are now subject to U.S. tax, and the U.S. government comes in at a certain point and thinks, oh, that point in time was way earlier than you say it is, then you haven't been filing tax returns, right? So therefore, you can be subject to penalties and interest for not filing and being late in your payments. Okay, so that's what's at stake here. Is the government can take their own perspective as to when you became a U.S. taxpayer. So we have a self-reporting system, so I think you can kind of build your facts and say, okay, this is the point in time when I become subject to tax, but just realize that the government can take a different view of that. Okay? They're never going to say it's later than you say, but they can say it's earlier than you say. Okay? So the answer on that question of whether the activities you're doing rise to the level of a U.S. Business and become taxable depends on an analysis of U.S. domestic law, so just U.S. statutes passed by Congress, signed by the President. These are very old rules. They rarely change these rules in the United States. These things are, as long as I've been practicing, are the same. Not like some of the rules we talk about that constantly change. So we have domestic law that tells us when a foreign person their activities become subject to U.S. tax. But we also have tax treaties, as we've been talking about on and on, and that has its own standard for when those activities rise to the level of a taxable U.S. business. Okay, so we first look and say, do we have a tax treaty? Then we examine the treaty, and we'll talk a little bit about the article that's in the treaty that's very common about the standards there. But if we don't have a treaty, we fall back to domestic law, right? If there's no contract between the countries, the U.S. says, okay, I'm just going to apply my rules. Okay? That's not unlike any other country. First you look to the tax treaty, and then you look to what the domestic law says. Okay, so irrespective of where we're going to start with U.S. domestic law first. So if the U.S. business is owned by a foreign person resident in a non-tax treaty country, so the way we tell if there's a treaty is where is the foreign person taxable tax resident? If it's a UK individual, if it's a UK corporation, we're looking, is there a UK-US tax treaty? The answer is yes. You can pretty much assume that any developed economy, we likely have a tax treaty. The US is a very, we like to have tax treaties because it gives certainty to our US corporations investing in those countries. And those countries like to have a tax treaty because of the size of our market, and they want to incentivize their companies and persons being able to invest in the United States. So we have lots of treaties with lots of countries. Common countries which we do not have treaties. We don't have a lot of treaties in Africa. We do not have a treaty with Brazil. Trying to think of any other. Obviously, the quote rogue countries that are out there that the U.S. doesn't have diplomatic relations with. We don't have tax treaties with. We don't even have diplomatic treaties But everything else, all the Western Europe, all of Asia, we typically have treaties with. So you'll find that obviously Canada and Mexico getting their crops. Yes, George.
When you talk of the U.S. Domestic laws, do you mean the state laws or the federal laws?
Federal laws. So the federal laws. So typically here, so we don't have a state income tax course here at WashU, but this question, usually states will follow the federal determination. So if the federal rules say that you're taxable, then you become taxable for the state. So the state doesn't have their own set of rules on this particular issue. Now, importantly, I was talking to someone the other day. They were talking about sales tax. So sales tax is a different tax, right? That's the tax on when you go buy something, you get taxed on your consumption. So states are, it's a, sales tax is a state tax phenomenon in the US. We don't have a federal sales tax. We don't have a VAT in the United States. So states can assert sales tax jurisdiction before you're subject to income tax jurisdiction. So if you're selling into the United States, e-commerce or what have you, and you don't have a business, quote, business that's taxable that we'll talk about, you might still be subject to state tax. So that's one instance where the states can jump ahead of tax collection, but solely for that sales tax question. All right.
Are they the same for every country, or they?
Good question. Good question. They are not the same for every country. So what happens is the U.S. has what is called a model treaty, and that's the example. So if they were gonna, if the countries decided they were gonna start a new treaty negotiation or update an old treaty that's in place, because some of these treaties are decades old. We've been doing this for a long, long time. So the U.S. would put forth a model treaty and say, this is where we want to start from. So we don't have to start from scratch. But then each country, you know, it's a negotiating power. Who's got the power in the negotiation? And you might get just like Trump with his tariffs and that. The same thing with withholding rates and all this stuff. So certain parts of the treaties get adjusted, and it's basically just a negotiation between the two. But what makes it good about having a model treaty is there's some uniformity to the contracts. So it's not like you read the U.S.-Canada treaty and then you read the U.S.-Chinese treaty and they're like totally different. I mean, the articles, Article 1, Article 2, 3, 4, have the same subject matter, but the details within might be slightly different. And back then, when I was first starting, you always had trouble reading the latest treaty because they always get amended, sometimes they get updated, and I was always nervous. Am I reading the latest and greatest thing? Now with everything at your fingertips, it's pretty easy to find. Few keystrokes, you can find the latest tax treaty. So you guys can type in right now and see, look at the latest U.S.-Chinese tax treaty, and it'll pop up. And so, good question. There's uniformity in the structure, but the details can be different. So you have to get into to read the exact. Okay. So if we're dealing with a non-tax treaty party, the investment in the United States is coming from a resident of a non-tax treaty country, then we only look to U.S. domestic law, okay, federal law. And the key here is relatively light economic activity in the U.S. can trigger U.S. taxability under U.S. domestic law compared to higher standards within the tax treaties. Okay? So if you're dealing with non-treaty, if I'm dealing with a Brazilian investment into the United States, it's not going to take a whole lot to get that Brazilian person to be subject to U.S. tax. Okay? Whereas if it's a UK investment to the U.S., there's going to be a higher standard. And look at that as they can do more things before they become subject to U.S. tax. Right? So slightly better, but you just got to make sure which one you're dealing with. Despite its importance, there is no comprehensive definition of what constitutes a business. Okay? In the tax code, it doesn't say a business is blah, 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 blah. Okay? Case law, which is court decisions, because you can imagine this is a lot of history in this area, so what is a business and what is not a business, suggests that business only exists if the activities within the U.S. are considerable, continuous, and regular. Right? Something that keeps going. one-off stuff, you got a better shot in not having a U.S. business. But if something is just continuous, and considerable, and regular in occurrence, that will start looking like a business. Okay? And obviously, to the extent it is more commercial in nature, sales, services, things like that that you would normally attribute to a business activity, those types of things will trip you up and you'll have a business. Okay, some examples. 10.1, Genevieve.
Yeah. So on this slide, we're looking at how U.S. domestic tax laws determine whether a foreign-owned business is taxable in the United States. So in this example, Forco is a foreign-owned but operates in the U.S. branch that sells widgets to U.S. customers. Because that branch activity is considerable and regular, that counts as a U.S. trade with business. So therefore, that kind of triggers the U.S. tax on the corporation effective tax income from those U.S. operations. So then Forco would report it by filing the Form 1120-F.
Yes. So the key words here is operations in a branch office and selling widgets to U.S. customers. So a branch office is going to indicate that they probably have employees and there's probably some regular activity, like they're doing multiple sales to multiple customers over time. That is just going to be a trade. That's going to be a business. Okay? Now you may hear me be saying trade or business. I think the trade language is kind of historical in nature, but it's the same thing. Just think of business activities. So just trade is kind of the historical reference. Okay, thank you. Okay. So importantly, the activities of a dependent agent. Think of an employee. So a dependent agent is there's a dependency between the employee to the employer and the employer on the employee, right? As opposed to an independent agent, which is I may get paid one time by this person, but I am not doing work for them 5 days a week and getting paid once a month. So dependent agents can be attributed to their foreign employer in determining whether the U.S. business exists for the foreign employer, which can lead that foreign employer to be subject to U.S. taxation on a net basis. Okay? So, and you have to be careful, and this is usually when, at the outset, when I would get questions about an inbound activity, is they're starting to send people over to the United States. What are they doing? That's the question, okay? So depending on what those dependent agents are doing, they may bind the employer, the foreign employer, to be having a U.S. trade or business. So you have to be very careful as to what those individuals are doing. Again, I caution always on this. Don't let the tax tail wag the dog, meaning that don't try really hard to curtail what these people are doing. You want to be successful in business, right? So if you got a superstar salesperson, turn them loose in the U.S., right? Generate business. Whatever they feel they need to do to drum up U.S. business, if that so happens to trip a U.S. trade or business, that's not the end of the world, okay? Because I always got pushback when I would say, okay, here's what they can and can't do to have a U.S. trade or business. And they would come back to me typically and say, well, they can't do that. My salespeople can't do that. When they're sitting there negotiating with the customer, if they want the product, they want to execute the deal right then and there. And the salesperson does as well. And I'm like, okay, that's fine. Just realize you probably have started a trade or business in the United States. Not the end of the world. But that's where you got to kind of just balance the business side with the tax application. Okay, so dependent agent, depending on what they're going to do, and we'll talk about that in a moment, can bind the foreign employer to have a U.S. trade or business. Contrast that with an independent agent. Okay, so an independent agent is someone who works for multiple customers, right? They are not tied to any one particular source of income from either a legal perspective or an economic perspective. So the independent agent's activities are not imputed to the foreign principal customer in determining whether a U.S. business exists for that foreign principal. Okay? For instance, if I have a non-U.S. producer and they're selling through Amazon into the United States. Amazon is an independent agent, obviously, right? They're one of the biggest companies in the world. They're not dependent on any one particular customer. So the activities they're doing are not imputed to the foreign person and attributing the foreign person to having a U.S. business. That's different than if the foreign person is sending their own employees over, dependent agents, to do this activity. Okay? So a lot of foreign companies will start doing business through these independent agents, right? See if I got a market. See if my product catches hold with the U.S. consumer. And see if I can get something like that before I start either sending my people over or getting a sales branch and hiring people to do this stuff for me. I want to kind of put my toe in the water, if you like that analogy, to see if that market is something I want to do. As I mentioned, to be an independent agent must be legally and economically independent of the principal, able and willing to act on behalf of more than one principal. Okay? I can be legally independent, i.e. I'm not an employee, but if that's my sole customer, the law says, well, yeah, but your only business comes from that foreign party. So you are actively a dependent agent. Okay? So sometimes people would get cute and say, well, there's no legal relationship there, but if that's your only customer, then effectively you're going to impute your activities to the performance of personal services in the U.S. is ordinarily considered a U.S. trader business. So if someone is in the United States and doing stuff from a service perspective, okay, and it's personal, so someone's doing it as an individual, that will normally be considered a U.S. business. However, under de minimis exception, the performance of dependent, i.e. employment, personal services by a foreign person in the U.S. on behalf of its foreign employer does not result in a U.S. business for the latter under the following circumstances. And remember, we're under domestic law. Okay? Domestic law, non-treaty situation. So that foreign person has to be present in the U.S. for 90 days or less. The foreign person does not receive more than $3,000 for the U.S. services. And the foreign person works as an employee of the foreign employer. This $3,000 here, one area where it's not, the number is not tied to inflation. So that's been 3,000 for as long as I can remember. So 3,000 15 years ago is not 3,000 today. That's a really limiting factor, especially if you're here for a quarter of the year. $3,000 is not much for 90 days. Right? So what this is saying is people here for a short period of time, there's a de minimis exception where we won't impute those activities to the foreign employer to pull the foreign employer into having a U.S. business. Why do we have this rule? Because we want companies to start trying out the U.S., right? If we had, oh, you step one foot in the United States and you're subject to tax, that's going to be a chilling effect to a lot of companies starting to look at the U.S. market. But if they could send people over here for a short period of time, explore the market, meet with customers, meet with suppliers, and that might lead to something bigger in the future. That's the goal of these de minimis rules. Is we understand that there's some startup time. We don't want to get involved in chilling that market, but if you start doing more than that, then that goes away, and we have to start talking about whether you have a trader business. So remember, 90 days or less, $3,000 are your key numbers. Okay, 10-4, and Genevieve, do you have this one?
Now we're looking at a situation where a foreign business does not create a U.S. trade business. So in this example, a foreign law firm sends one attorney to the U.S. for half a day to meet with a client's U.S. subsidiary. She earns $2,500 for that service and immediately returns home. So because she was in the U.S. for fewer than 90 days and earned less than $3,000, the foreign law firm was not otherwise engaged in the U.S. trader business. This activity does not rise to the level of a U.S. trader business.
Or the foreign law firm. Okay. I take issue with the way the authors drafted this question. So, a couple things to keep in mind here that I mentioned over here. So, foreign law firm actually owns a U.S. subsidiary. This is a corporation, right? When we do a box, that's a corporation. That entity pays tax. U.S. corporation, right? Remember we talked, that's a U.S. person subject to tax, right off the bat. No question whether it's a U.S. business or not. You're a U.S. taxpayer by virtue of being a U.S. corporation. So that company files a tax return, pays tax at 21%. The question in this example is, does this activity of this individual pull this party into having its own U.S. trade or business? Because they're sending an employee over to do something. And this is where the de minimis exception can apply. And it basically says foreign law firm doesn't have itself a 1120F filing. The 1120, so Form 1120 is the U.S. corporate tax return, and certainly U.S. sub files an 1120. Question is, does foreign law file an 1120F as being a foreign person with the U.S. trade or business by virtue of the foreign attorney's activities in the United States? And you can sense from the facts here, it's very short. In a day trip to the U.S., right, and goes back, that's not going to, that's going to be in the de minimis rule, not pull foreign law firm. But keep in mind, U.S. sub here does pay tax. It's a U.S. corporation. Okay, so now let's shift to if we have a tax treaty in place. So now, if I have a tax treaty in place, everything we just talked about, it goes off to the side. Now I have a document that I look at that provides standards that supersedes what U.S. domestic law is. So I put in the bubble, tax treaties trump U.S. no pun intended there. Trumps U.S. domestic law in determining whether a foreign person's U.S. activities will result in a U.S. Business. Okay? And that's just in our Constitution, that treaties between countries rise to the level of supreme law of the land. Okay? So, if a U.S. business is owned by a foreign person that is resident in a tax treaty country, if you're in my advanced international course, when we talk about tax treaties, the first question is the foreign person we're dealing with a resident of that treaty country? Right? Because we can't just have anybody saying, hey, I'd like to apply the UK-US treaty. Well, are you a UK tax resident? And that's going to be defined in that treaty as to who is a resident, who is not. We also define who is a resident and who is not of the United States. So that first that party has to say, hey, I am entitled to apply this treaty because I am a resident in this country. Okay? So assuming we get through that threshold, then we look at the thresholds espoused in the tax treaty, not the thresholds that we just talked about under U.S. domestic law. A relatively higher level of economic activity is required to become subject to U.S. tax under a tax treaty compared to domestic law. I.e., meaning I could do more things in the United States before I trip the threshold to become taxable in the United States in a treaty situation. Okay? All treaties where the U.S. is a contracting party exempt a foreign person's business profits from U.S. taxation. So first, we do not tax you unless those profits are attributable to a permanent establishment. Everyone calls it a PE. Okay? A defined term in those tax treaties. This, to Arthur's point, is pretty well similar in all treaties. We define what is and what is not a permanent establishment. So think about businesses. They really like this because this tells you exactly, and it gives you lots of examples when you read that article about what is and what is not a permanent establishment. So you can choose to do those things or not do those things. What works for your business, what does not, and kind of have something to rely on that's not as subjective as what rises to trade business. Most tax treaties where the U.S. is a contracting party contain two alternatives by which a permanent establishment in the U.S. is deemed to exist. The first is a fixed place of business in the United States. So, fixed place of business. I always think of bricks and mortar, like a place. Like you have a store, you have a restaurant, you have a warehouse, you have an office building. Whatever you're doing that I can go out and I can knock on the door, right? That's a fixed place of business. You're going to have a U.S. permanent establishment with a fixed place of business. Okay? Now, this is These are very old provisions, very old documents, so they many times supersede today's economy, right? You don't have to have a fixed place of business to do a lot of business, right? Think of all the e-commerce that's done. Amazon does not need a lot of fixed place of business. Now, they do need warehouses because they got to get the stuff to us from a certain place. But think of, like in Europe, they could have a central warehouse that can serve multiple countries. And they're not physically present. They don't have a fixed place of business in any country. Okay? So, this is where the U.S. kind of differs from the rest of the world. The rest of the world is really concerned about the level of activity that can be done without a fixed place of business. Meaning, you can do a substantial amount of economic activity without being a taxpayer. The U.S. still relies on this fixed place of business. I think it's probably fair to say, why do we do that? Because most of the biggest countries in the companies in the world that can do activities without a physical place of business are U.S.-based companies, right? They're already subject to tax in the United States because they're U.S. companies, right? But if you're doing activities into France, Google doing a bunch of activities into France, France is saying, okay, you're accessing our customer market without paying tax just because you don't have a store, you don't have a warehouse, you don't have a building. That doesn't make sense to us. So what they've been doing is putting pressure through the OECD, the Organization for Economic Cooperation and Development in Paris, a collection of the largest economies in the world, to try to lower the fixed place of business standard. Okay? The U.S. is trying to keep the fixed place of business standard. Why? We're trying to protect our businesses from being subject to more tax abroad. Those countries are doing the exact opposite. They want to collect more tax. So it's a negotiation position between the two. We will dive into this. This is evolving as we speak in Advanced International. It's just that tension between the rest of the world standard and the U.S. standard. And so, but when we have a tax treaty, the words in the treaty you can rely on. If it says fixed place of business, that's what we can rely on. Importantly, there are accepted fixed places of business, include those solely for purchasing, storing, displaying, delivering inventory, or collecting information about potential customers. So that's quite a bit that don't count as a fixed place of business. Why is that? Because we want to incentivize the two countries that are signing the treaty, want to incentivize the business activity between the countries. So if you're doing stuff that are more preparatory or auxiliary to the business, you're collecting information, you're displaying your goods and stuff like that, that may, in ordinary terms, be considered a fixed place of business, but it is not for purposes of the treaty. And that's for you to be able to have some leeway to get started, to explore, right? Again, treaties are a higher standard. You start doing that stuff in a non-treaty standpoint, you might be subject to tax. Okay. The second, so there's two alternatives. The second alternative that can give rise to a permanent establishment is when employees or other dependent agents habitually exercise the authority to conclude contracts in the name of the foreign person in the U.S. Okay. This was the example I was saying with the superstar salesperson who comes over in the United States, right? If they're meeting with a big account, potential account, and it's a great meeting and everything's going good, guess what? Let's sign the deal right now. If you do that, in a treaty standpoint, you are binding your foreign principal and you executed that contract in the United States, that will give rise to a permanent establishment in the United States. Okay? This is where I was saying, don't cut off your nose to spite your face. Don't not execute the contract solely for the purpose of you don't want to create a U.S. taxable presence, right? That's where you gotta don't be too selfish and not to pay tax. Just get the business deal done. Yes, Colin.
Can they just verbally execute the contract and then later
Yeah, this is where
Everybody
everybody starts trying to get cute around the rules. Oh, okay, I didn't actually sign the document, but I wink, wink. Yeah, I will get that signature on it. Well, that's when it starts to get a little blurry. And did you do 99/100ths of the negotiation and all you did was not execute it, not sign it in the United States? That's where the US says effectively it was done. So we'll talk about one thing here that's the key planning idea here is what you do is you send the contract back to the home office, the foreign person, for vetting and execution. Okay? Meaning that they're going to review the terms, the sales price, that type of thing, and maybe suggest changes. Then you guys can sign it. That would pull you out of this problem of habitually executing contracts on behalf of the foreign principal in the United States. But think about the superstar salesperson. Ain't gonna like that, right? Either you trust me or you do not trust me to execute the deal. I had this great meeting, client was all going, they wanted to buy more than what we thought they were gonna buy. I had to sign it then. It was now or not. Instead, I'm gonna say, oh, this is a great meeting, but pause, I have to send this back to my home office for them to review and execute, and I'll try to get back to you in a week. There's a natural tension there, right, between business and tax. So, but as Holly was saying, people try to get really cute around this and like go all the way to the edge, and just there'd be a time when going all the way to the edge, doesn't accomplish what you're trying to do. Okay, I put here the exact terms of each treaty need to be examined carefully to determine applicability along with the substantive rules. So, you need to read the treaty. If this is the question you're dealing with, and you've got a UK person starting to dabble in the United States, open the treaty, read the permanent establishment article, talk about it with your client, make sure everybody understands exactly what can and can't be done. And if the business needs to go beyond that, not the end of the world, here's what we got to do, okay? Just so everybody knows what's going on. Okay, let's do 10.9. Did anybody sign up for 10.9? Why not? I swear I have 10.9 on mine.
So, Foreign Co. is a Country F corporation that manufactures widgets. Foreign Co. Employs a Country F citizen and resident that spends 3 months a year traveling throughout the United States and soliciting widget purchase orders from U.S. customers. The sales employee has the customer sign purchase orders, which she forwards to Foreign Co.'s home office, Country F, for final approval. Under the non-treaty U.S. trade or business standard, activities that the sales employee would constitute a trade or business for Foreign Co. in the United States.
So that's just saying it's continuous, regular business. The things I take away from that is 3 months a year. Seems to me that it's 3 months every year. It's kind of implicit in that language. So the person spends a significant amount of time here, traveling throughout the United States, soliciting purchase orders, and has the purchase orders signed in the United States. If I'm not in a treaty context, the treaty standard does not help me. Therefore, I'm likely going to have a U.S. trade business. Again, not the end of the world, but at that point, I'm probably filing a U.S. tax return.
However, if Foreign Country F has a treaty with the United States, similar to the U.S. model treaty, Foreign Co. would not be subject to U.S. taxes, as Foreign Co. would not have a permanent establishment in the United States due to the sales employee's lack of final contracting authority.
And so that's resident at Forco. I do, in this instance, they do send it back. And this is important that sending it back for vetting and approval, that can't be a perfunctory exercise. Like 100 out of 100 contracts get approved without a substantive change to the contract, right? That's where the U.S. is going to say effectively it was executed in the United States. That's just an administrative thing. So you would like to see some kind of, why did you say it was for $10? I would like it been for $10.50 or $11 or something like that. Can we change that? Can we change the payment terms? Things like that that would be important for the home office to have a real substantive review with some editing. Right? Okay, with respect to personal services, so think about employment activities performed in the U.S., tax treaties usually provide greater exemptions than afforded under U.S. domestic law. Why? The higher standards in the treaties which allow more activities to be done before you're subject to tax. A common tax treaty article exempts income derived by a foreign person from personal services performed in the U.S. in the following circumstances. The foreign person is present in the U.S. for 183 days or less. Contrast that to the non-treaty standard, which was 90 days. Twice the amount of time I can be in the United States. Half a year I can be in the United States if the foreign employer is in a treaty country. And the foreign person is compensated by an employer that is not U.S. resident nor borne by a permanent establishment in the U.S. That means there's no other U.S. activity other than these employees coming to the United States. I put in the box there. Notice the extension of time, 183 days from 90 days, and the lack of a maximum dollar amount. Remember that $3,000 I said that wasn't indexed for inflation? You're going to trip that $3,000 if somebody stays multiple weeks in the United States. This doesn't have even a dollar threshold. So if I can manage my 6 months, that 183 days, I can have a lot of compensation, a very well compensated individual coming over doing that activity without the personal services imputing and pulling in my foreign employer into having a U.S. taxable presence. Okay. Again, the tax treaties trying to pull down or raise up thresholds, I will say, to allow more activity before you pass up tax because they're trying to encourage economic activity between the countries. Okay, 10-10. Anybody want 10-10?
Forco is a company incorporated in foreign country F, which has a treaty with the United States similar to the U.S. model treaty. Forco is in the refrigeration business. Due to the high demand for air conditioning repair services in the United States during the last week of July, Forco sends Norman Ray Allen, a citizen and resident of country F, to serve customers. During that week, NRA helps repair air conditioning for 15 different customers of Forco. The compensation that Forco pays NRA is $20,000.
So the first thing, right, you mentioned, we're in a treaty situation. Forco is a resident of a country that has a tax treaty with the United States, so we're going to go to the standards we just looked at. Right? Oh, you're going to read that?
Oh, sorry.
The
Florida law
punchline.
is not taxed on its $20,000 compensation for services it performed in the United States pursuant to the treaty because 1, NRA is in the United States for only 92 days, which is less than 183 days. 2, NRA's compensation is paid by Forco, which is not a resident of the United States. And 3, NRA's compensation is not borne by a permanent establishment that Forco has in the United States.
Yeah, so this is just saying, I don't have any other U.S. activity, I'm just sending somebody over to service the products that I've sold in the U.S. And so that activity, because I'm in a treaty situation, I can do a lot more in terms of length of time and compensation without pulling Forco into having a U.S. taxable presence. Okay? If Forco was not in a tax treaty jurisdiction, this would be a problem because sell over 90 days. Okay. Okay. Comparing determinations under domestic law and tax treaties. Does somebody have 10A? Anybody want 10A? George.
OREC is a foreign corporation that breeds and races thoroughbred horses. OREC ships a horse Carolina to race in the Kentucky Derby. Immediately after winning the Kentucky Derby, OREC ships Carolina back to the foreign country. OREC's entering a horse in a single race constitutes a U.S. trade or business under the code, and OREC's wins will be effectively connected.
What that's saying is non-treaty, that this relatively light touch, if you ask me, just coming in for one race and then I'm leaving, it's probably the magnitude of the winnings is probably a factor here as well. I don't know Triple Crown race. I don't know what the winner is, but I'm sure it's multiple millions of dollars. So, and the horse probably didn't come in the morning and leave the afternoon, probably came in, stayed for 2 weeks before, got used to the track, that type of thing. So I think those facts that aren't necessarily listed here probably bear into this. But this one's probably, in my mind, more towards the line of possibly not being a U.S. taxable presence. But the authors are saying it does cross that line, but it's certainly close to it, I would say. It's not like they did all 3 Triple Crown races or were in the United States for 3 or 4 months doing racing activities. It was one race. But, hey, the biggest horse race in the world. Okay.
Yeah. However, if Farek is a resident in the foreign country that has a tax treaty with the US, the winnings will not incur US tax because Farek does not have a US permanent establishment. Further assuming that Farek operating under the tax treaty, under the treaty standard, are kept together in the US to raise in the pregnant states, development states, it's possible that Farek may then have a permanent establishment that would subject
So if it's say for one of the Triple Crown races, says probably not, because we're not going to hit those thresholds of being in the U.S. for a substantial period of time. But if we say for all 3 races, perhaps we're starting getting closer to that line as well. So I think this just shows you the sliding scale of what's there. And the facts are very, very important here in making the determination and build your case as to why at this particular point in time I either become taxable or what are my facts that support why I am not taxable? That's really important. Okay, 10.9. Somebody want 10.9? One down, Virginia.
So this one we're also comparing information on domestic law and also tax treaty. So it says Forco sent a sales employee to meet with a U.S. customer at the food court at Chicago O'Hare's Airport. Between their first and second Chicago style hot dogs, the U.S. customer signed a purchase order that will bind Forco only if approved by Forco management in country F. If Forco is located in a treaty country, Forco does not have a permanent establishment in the United States and does not have U.S. tax liability.
So that's the vetting and execution outside the United States. So signing the purchase order, but it's got to get sent back to the home office to decide if it's going to be signed or not, or it needs to be changed. And that is only relevant in the treaty standard.
If Forco is located in a non-treaty country, the activity of Forco's sales employee in the United States results in a U.S. trade or business, and Forco will have to pay U.S. tax once effectively connected.
That's probably because there's a negotiation with the customer and execution of a purchase order. That would be a slightly lower standard than execution outside the United States. Okay, so let's say I have a presence in the United States. Okay, I've made that determination that either in a treaty context or a non-treaty context, I'm going to say at this point in time, I am now going to say I am subject to U.S. tax. I'm going to file a tax return. Well, what's the quantum of income subject to U.S. tax? That's not easy to do, right? How much income is attributable to the U.S. activity? And even as important, how many of my expenses relate to that income? Right? Because I file a U.S. tax return. The Form 1120-F looks so similar to the Form 1120. Got income, expenses, it looks exactly the same except for the title. So I need to first, how much income is attributable to the U.S. business, and then what expenses can I put against that? There has to be a causal relationship between the expenses and the income to get to my taxable income. I can't start just loading it up with a bunch of non-related expenses to lower my U.S. tax liability, right? So determining a foreign person's quantum of income subject to U.S. tax is a complicated exercise, especially when making the determination under U.S. domestic law. Okay? So not only may you get a dispute as to when you become taxable, you might have a dispute with the U.S. And the IRS on how much is taxable, right? Think of that horse racing example, right? Clearly the winnings of the Kentucky Derby, that's going to be your income, right? Well, what expenses? Probably all your stable and expenses and stuff while the horse is in the United States, but what about transportation? What about the people that had to come with the horse, right? Take care of the horse. What about food? What about all that? So what about the hotel stay for the people that are managing the horse while they're here, you know? So that type of thing is the question, is that you gotta build that income statement, if you will, that you're gonna put on the 1120 app. And many times, that is not, if you're in my taxation of business entities course, we're talking about how we have column A, which is our income statement. And we can then, we're making book tax differences to arrive at taxable income. You might not have an income statement, right? That horse race example, there's no income statement for that. You gotta start like building it. Income's probably simple. What's the expenses that relate to that? Okay? So you need to determine their effectively connected income with the conduct of the trade or business. That effectively connected income is just the causal relation. What income relates to that U.S. business? But it's always called effectively connected income. People will call it ECI, but that's what it's talking about. What income is related to the U.S. activity? Because again, we don't get to tax the non-U.S. activities of a foreign person. We don't have any jurisdiction over that. Most of the person's U.S. source income is included under a force of attraction rule, other than most of its income that is taxed under U.S. withholding tax rule. That's just saying if you have other U.S. source income, and you might have a U.S. business, we're probably going to put that U.S. source income in that U.S. business. I think it is an administrative rule. They're saying it's probably related to that business, so they call it force of attraction. That ends up being recorded on that form 1120F. In cases where a tax treaty applies, the taxes attributable to the USP are subject to U.S. tax, with the standard being somewhat vague and a little way of guidance. So, again, the threshold, we might have a little more guidance in the tax treaty, but nothing tells us what goes on the tax return, right? You have to prepare that. And just like any tax return we do in the U.S., you self-report, and the government has the opportunity to audit that and ask questions about that. Well, what's this? What's this expense? What's that in? Why isn't more income associated with that? What I've cautioned my inbound clients that are just getting started, it's not uncommon to see a startup business, as you guys know, to run losses. Usually businesses don't start off profitable, so you might run losses. But what if I have a 10-year U.S. startup that continues to run losses? You're going to start inviting questions from the tax authority, like, who in their right mind would do business for 10 years and lose money every year, right? Because it might be indicative that you're putting too many expenses on that tax return. Keep from paying U.S. tax. Yes, I'm a U.S. taxpayer. When I file my tax return, I don't have any tax liability. So it might be a question of, are you putting too many headquarter expenses in there, and there should be more taxable income in the U.S.?
Is that where you can do like the net operating losses and then you can like carry forward it like over a number of years?
Yes.
Okay.
You can certainly do that with an NOL, a net operating loss, which is your current year expenses exceed your income. Now that assumes those expenses relate to that income. And that could be very much the case in a startup, right? Got a lot of activity trying to generate future income. But how long is your startup vote? 10 years? When is that? So the U.S. wants to see some activity.
And how would like stock-based comp like get factored into it?
Say again?
Stock-based compensation, like how would it get factored into it?
So that's a great
Part of certain
question. So
expenses.
you can, the direct causal relationship, so my example of the horse that they brought over to run the Kentucky Derby, I would say transportation probably should go against that. Obviously boarding and feed should go against that while they're in the United States. But what about if the person that's the trainer of the horse is one of the best trainers in the world and has stock compensation? Does a portion of that stock compensation get attributable to their portion of the year that they're in the United States? I would argue yes, right? It's not, a normal person off the street can't train a horse, one of the most prestigious races in the world. So yes, there might be some extra compensation, and so that apportionment would have to happen. So if they spent 2 weeks in the United States, maybe it's 2 weeks out of 52 weeks times the stock-based compensation that gets allocated to the U.S. That might be worth a shot putting on that tax return to see. But it's all about you can apportion some of those expenses, but just beware how far you go. Like rent expense for the headquarters in the foreign office, and then the headquarter office is probably not going to be allocated to the U.S. tax. Okay, that's this last part here. The ratable share of any indirect but related deductions can be put on the tax return as well as directly related. Okay, we talked about the tax return filing requirements. A foreign corporation that is engaged in a U.S. business must file Form 1120-F, U.S. income tax return of a foreign corporation. If you're a foreign individual that is doing business in the United States, and that's a 1040-NR, non-resident alien income tax return. They're very similar to the 1120s for U.S. corporations and the 1040 for U.S. individuals. But you're just accommodating that non-U.S. element of filing into the United States. Okay. Last topic for today is branch profits tax. So that was the standard at which we become subject to tax if we're doing business in the United States. Treaty, non-treaty, where of the people travel and whether that's going to be imputed to the foreign employer and back to the United States. Okay, so this assumes we are taxable in the United States. So we have a branch in the United States. When I say branch, think of it as an extension of the foreign parent into the United States without a legal entity. Okay? We're starting to do sales activities in the United States, so it's continuous. Maybe they even have a warehouse, they have a sales office or something. So whether you're in the non-treaty standard or the treaty standard, you have a U.S. business that is taxable. Okay? So I'm on slide 20, by the way. Prior to the enactment of the branch profits tax, which is very historical, as long as I've been practicing, there's been a branch profits tax. So it's not anything of the relatively recent tax bill. Substantial tax differences existed between the treatment of earnings repatriated abroad from a U.S. corporation and a U.S. branch. So what we're going to be comparing here at the outset is I have a foreign operation. Let's say they're investing into the United States via a U.S. branch. When I take the profits out of the U.S. activities, when I take money out of a branch, that is not a dividend. Right? Like you were in my individuals class, it's like a sole proprietorship. You say right pocket, left pocket. There's no taxable event when you take something out of a branch. You take profits, after-tax profits out of a U.S. corporation, that's a dividend, right? The distinction is dividends are potentially subject to withholding tax. Branch distributions are not subject to withholding tax because they're not a distribution. A branch, it's right pocket, left pocket. It's an extension of yourself. So dividends of earnings of a U.S. corporation to its foreign parent incurs withholding tax, while the same repatriation of earnings from the same activity but conducted in a U.S. branch form does not, because a distribution from a branch does not give rise to a dividend. Okay? So it doesn't matter the type of activity. You do the same activity, two taxpayers doing the exact same thing. One's doing it in a corporation, one's doing it in a branch. Branch profits tax is trying to fill in that gap of the lack of withholding tax on the same distribution of earnings from a branch that would have occurred if you had done business in a corporate form. Okay, this example, a lot going on here, but this shows that exact dichotomy. Anybody want 1024? Don't be intimidated by all the stuff. Well, never intimidated.
Forco, a foreign corporation, owns 100% of the shares of USA Co. A US corporation that derives all of its income from US business operations. During its first year of operations, USA Co. has taxable income of $10 million and distributes all of its after-tax earnings to Forco as a dividend. Assume the US corporate tax is 21%. Applicable withholding rate for the U.S. source dividends is 30%.
So this is the picture on the left. So Forco decided to do this activity and assume the same activities on the left picture and the right picture. They're doing it in a U.S. corporation. So they make $10 million. They pay tax. U.S. corporations pay tax, right? The $10 million is subject to 21%, so there's only 7.9 million left. Pay it.
Side note, so if you notice the same amount of income tax is paid in the US, whether the US operation is conducted in corporate form via Form 1120 or branch form via Form 1120F. The branch profits tax focuses on the difference in withholding tax.
Yeah, so the 2.1 million is the same, because I have a U.S. business, right? We know U.S. corporations are subject to tax at 21. What we just talked about in the first part of this class is the right-hand picture, which Forco is doing activities in the United States. That activity rises the level of a U.S. presence. So in theory, the same amount of income is subject to the same rate of tax. Right? 2.1 million. Okay.
USA Corp pays $2.1 million of US income tax on its $10 million of taxable income, and then distributes a dividend to Forco of $7.9 million. That is $10 million of taxable income less $2.1 million of US income tax.
Because that's the only amount they have left, right? They paid 2.1, that's what's left is 7.9 is the actual tax.
The dividend incurs $2.37 million of US withholding tax, and is 7.9 million US dividend times 30% withholding tax rate, making the total US tax burden on USA Co's repatriated earnings equal to $4.47 million. That is $2.1 million of US income tax plus $2.37 million of US withholding tax.
So since they give us nice rounded numbers, 4.47 million of total U.S. tax, income tax and withholding tax to get my money out to the foreign parent, is a 44.7% tax rate. Pretty hefty, right? My slice of the pie is much smaller as the business, right? If I decide to do this in corporate form, so Claude, being the smart advisor, says, do this in branch form, and so cover that last paragraph.
Forco had structured its US operations as a branch rather than as a subsidiary. Forco would still pay $2.1 million of US income tax on its $10 million of income effectively connected with the US branch operation. However, absent the branch profit tax, the repatriation of branch profits would constitute an internal fund transfer that is not subject to US distribution.
So that's just a fancy way of saying pulling the money out of the branch operation, the same after-tax profit, 7.9 million, comes out not as a dividend. We only withhold on dividends, on repatriation of earnings. And so that would mean now my effective rate of tax is 21% versus 44.7. Sounds like, wow, I should do this in branch form. The branch profits tax makes sure that I don't avoid that. If not, all of our foreign business, foreign investment into the U.S. business would be done in branch form, because I'd avoid dividend withholding tax. So branch profits tax is trying to fill in that gap that would otherwise occur between these two examples. Okay, this is trying to show you the problem absent. Problem from the U.S. side, the opportunity from the foreign side, if we did not have the branch profits. Okay, thank you. Okay. The branch profit tax equates the treatment of a U.S. branch with that of a U.S. corporation by imposing a 30% tax on repatriations from the U.S. branch to its foreign owner. Okay? We assert that because we have taxing jurisdiction over that branch, because that's the U.S. activities. Right? We can tax that. So, as with the case of withholding on dividends from a U.S. corporation to its foreign shareholder, the branch profits tax rate of 30 can be reduced via tax treaty. So one of the provisions right after the PE article is dividends article. And many times that statutory U.S. tax rate of 30% is lowered. That's one of the things that a tax treaty can do, is lower withholding tax rates, going both ways. But sometimes it goes down to 0. Many of our most favored trading countries, we will negotiate a 0 rate of withholding tax on dividends. So in that instance, the branch profits tax is not 30%, it gets pulled down as well, right? Because the treaty partner knows, like, well, you have this branch profits tax, I don't want to then do the example that Claude just went through and make the branch operation much more burdensome by imposing a 30% branch profits tax than I do on dividends, which might be 0 under tax treaty. So if my dividend withholding rate got pulled down, most likely my branch profits tax somewhere in that tax treaty is going to pull that 30% down. Okay. The tax base for the branch profits tax is what is called the dividend equivalent amount, a defined term which approximates the amount of U.S. earnings that a U.S. branch remits to its foreign owner during the year. Because we don't have a real dividend, right? Legally, it doesn't exist. If you start talking to the attorneys or talk to accounting about a dividend, they're going to be like, hey, stupid, that's not a corporation, that's a branch. It doesn't have a dividend. This is a fictitious U.S. tax world we're in. We're going to deem a dividend equivalent amount. Okay, 1025? Okay.
Are the same as in the previous example, except now Forco must account for the effects of the branch profits tax. If Forco had structured its U.S. operations as a branch rather than as a subsidiary, Forco would pay $2.1 million of U.S. income tax on its $10 million of ECF. In addition, assuming the U.S. branch's dividend equivalent amount equals the branch's after-tax earnings of $7.9 million, which you get from subtracting $10 million of taxable income and the $2.1 million of U.S. income taxes, Forco also would incur a branch profits tax of $2.37 million, which is the result of multiplying the $7.1 million dividend equivalent amount times the 30% tax rate. And because the branch profits tax creates a shareholder level U.S. tax that is equivalent to the U.S. withholding tax imposed on dividends, the total U.S. tax burden on USACO's repatriated earnings equals $4.47 million, which you get from adding $2.1 million of the U.S. income tax and the $2.37 million of the U.S.
Yep. So that prior example that Claude went through, we're equating the right side to equal the left side. So we're taking away the tax incentive of potentially doing business in the U.S. in branch form by saying you're not going to avoid withholding tax. You might avoid withholding tax, but it's going to be replaced with branch profits tax. Okay, that's the whole concept behind that. So the dividend equivalent amount, what we have to do if we're going to equate those two percentages, we can't just take the after-tax earnings of the branch and subject it to branch profits tax, because on the left side, dividend withholding tax is only incurred if and when a dividend is declared by the board and paid. Okay? So what if it doesn't do that? We have to account for that. That's why there's this dividend equivalent amount to say, well, there are instances where on the left side of the example that Claude went through, they may not pay a dividend. Right? They may reinvest the earnings in the business. So what if the branch's profits are reinvested in the branch's business? It's growing. So there is effectively no repatriation. Okay? We determine that via the dividend equivalent amount. And it's a two-step procedure. First, we compute the earnings of the foreign shareholder properly attributable to the branch. We have to do that exercise of the quantum of income and expenses that belong in the branch. And then we adjust the earnings of the branch for any changes in its net equity for the year. This is trying to say, did money leave the branch and go to the parent versus staying and being reinvested in the business? An increase in the net equity reduces the dividend equivalent amount as it represents a reinvestment of earnings. Whereas a decrease in net equity increases the amount of the dividend equivalent amount as it represents a distribution. Okay? I think these examples show that well. Somebody want 1026? Sure.
Forco, a foreign corporation, operates a branch sales office in the United States. During its first year of operations, Forco earned effectively connected earnings and profit of $250K, and its U.S. net equity is $500K at the beginning of the year and $750K at the end of the year.
So let me pause you there. So that effectively connected earnings and profits of $250, paying tax at 21% on that, right? Because it's a U.S. business. On 1120F, that paying tax 21% of the 250. This is in addition to that. Okay.
Therefore, Forco's dividend equivalent amount for year one is 0, and the branch profits tax is 0. In theory, the U.S. branch has reinvested its $250K of profits in the United States instead of repatriating the profits of Forco's home office. So, A, effectively connected earnings and profit of $250K, which is step 1. B is increase in U.S. net equity, which is end of the year U.S. net equity minus beginning of the year U.S. net equity, which is an increase in U.S. net equity of $250K. And the dividend equivalent amount is A, which is $250K, minus B, which is also $250K, which equals nothing.
What they're trying to say here is the operation made $250,000, but it was reinvested in the business, right? It's growth oriented, so it kept the $250 into the business. Therefore, to equate the two hypotheticals in Claude's example, the corporate scenario on the left, they probably didn't pay a dividend, right? Because they kept the $250 in the business. So I didn't incur the withholding tax. I don't incur the branch profits tax here. I'm trying to keep symmetry between the two, right? Why don't you stay here and do year 2? Yeah.
During year 2, Forco does not have any effectively connected earnings and profit, and its U.S. net equity is $750K at the beginning of the year and $600K at the end of the year. Therefore, Forco's dividend equivalent amount for year 2 is $150K, which results in a branch profits tax of $450K, which is 30% of $150K. So A is 0. The B increase in U.S. net equity is beginning of the year of $750K minus the end of the year U.S. net equity of $600K, which equals a $150K decrease in U.S. net equity. Your dividend equivalent amount is A of 0 plus B, which is $150K. Ending amount is $150,000.
Yeah. So that's just saying I had equity of $750, went down to $600. Think of the equity section of a corporation, right? If net equity goes down, I either lose money or I made a distribution. I didn't lose money because step 1 says I broke even. I made a $150,000 distribution, and that would have been equivalent in that prior example of paying a $150,000 distribution subject to dividend withholding tax in the corporate scenario. Here, this is a branch scenario, so we hit it with branch profits tax to maintain symmetry. So if you go through that 2-step process, you will always get the dividend equivalent amount, and that is the branch profits tax. Okay. Long-standing provision. Okay, thank you. Okay, so we'll pick up on Wednesday. We'll cover interest expense and BEAT, and I'll probably send you a ranking that we can decide if you want to talk through at the end of the class, anything you want to do on the final exam. Okay? All right, let me know if you have any questions as you're studying. Thank you. Those of you that volunteer, please put your name on the spreadsheet. I didn't see your name there.
Relax, the cheat sheet. I didn't really do too much. Oh, I started last night.
Yeah, so you only go through like the first chapter.
Yeah. Tonight and tomorrow night.
Yeah.
Yeah. Yeah, we'll see.
I'm gonna try to do 3, 4, and 5 today.
You already did 1 and 2.
I'm
Can I
doing
get the
one.
signage?